You can build a perfect machine and still wreck it. Over this whole series, we bolted together something genuinely powerful. An engine that turns money into more money, fed the right fuel, assembled the right way, switched on at the right time. And here's the uncomfortable truth about a machine that good. The market can't really break it. Recessions can't break it. Crashes, headlines, bad years, none of them break it. There is only one part with the power to wreck the whole thing, and it isn't out there in the world. It's the operator. It's the person who reaches in and pulls the wrong lever at the worst possible moment. Today, in the finale, we meet that operator, because they're staring back at you in the mirror. This is the last episode of The Compounding Machine, so we're going to do two things. First, a fast recap. The entire machine in a single frame, so all 6 previous episodes click into one picture. Then the thesis this whole series has been quietly building toward. Behavior beats brilliance. You do not need to be smart to win at this. You need to not be your own worst enemy. 6 beats. 1. The whole machine in one frame. 2. 2 investors, same fund, wildly different endings. 3. The 4 wreckers that sabotage good machines. 4. Why time in the market beats timing the market. 5. The one-page plan that protects you from yourself. And 6. The real scoreboard. What this was all actually for. Let's put the machine back together. Step back and look at what we built. In the center is the engine, compounding from episode 2, the quiet gearbox where money earns, and the earnings earn too. And the curve bends upward over time. That engine needs fuel, so we gave it 3 kinds. Stocks, from episode 3, the growth fuel, owning tiny slices of the whole economy. Bonds and cash, from episode 4, the ballast, the calm fuel that keeps the ship upright. And real assets, from episode 5, a small seasoning of things you can touch. Episode 6 bolted them into one portfolio. And the whole reason we switched it on back in episode 1 is that saving alone quietly loses to inflation. The jar sits still while the world gets more expensive around it. So standing still is really sliding backward. That's the machine. Every part earns its place, and together they do something no single part could do alone. It works. So what goes wrong? Here's what goes wrong. For 6 episodes, we've obsessed over the parts. The engine, the fuel, the allocation, the automation. We tuned every component you can see. But there's one part we never once put under the microscope, and it's the single most important one, the operator. You, the person whose hands are on the controls. A beautifully built machine run by a panicking operator will underperform a mediocre machine run by a calm one every single time. The math of investing is genuinely simple. A bright 12-year-old could learn the whole recipe in an afternoon. What's hard is human. It's staying in your seat when every instinct is screaming at you to jump out. Think about how strange that is. We spent 5 episodes learning the parts, and it turns out the parts were the easy bit. The financial industry sells you complexity. New funds, hot tips, clever moves, because complexity is profitable to sell. But the thing that actually decides your outcome is almost embarrassingly plain. Can you leave a good thing alone? So this finale isn't about a new part. It's about the hand on the lever. Beat one. Let's make that recap real, because seeing it whole changes how you treat it. Picture one clean diagram. A paycheck arrives on the left, and a slice of it peels off and drops into the machine. That's you paying the machine first, before you spend the rest. It falls into the engine, the compounding gearbox, the beating heart from episode 2, where each dollar earns and those earnings go and earn too. The engine burns 3 fuels, the green growth fuel of stocks, the blue steady fuel of bonds and cash, the amber seasoning of real assets, mixed in whatever ratio matches your timeline and your stomach, which is the whole job of a portfolio. The gears turn, and out the far end, over a long time arrow, comes a pile that's far bigger than everything you fed in, because the machine, not you, manufactured the difference. That is the entire series in one image. 6 episodes, one machine. And notice what's missing from the diagram. There is nothing in there about being clever, nothing about picking the perfect moment, nothing about beating anybody. It's a boring, well-built appliance that runs on autopilot. Everything that could go wrong from here has nothing to do with the machine, and everything to do with whether you leave it alone. Beat 2. Let me tell you about 2 investors because the gap between them is the whole point of this episode. Same person, roughly, same income, same discipline. They both put the same money into the same boring, broad, low-cost fund, and they both leave it for the same 20 years. Identical machines. Now here's the only difference. Investor A does nothing. Through every scary headline, every crash, every "this time it's different," she simply does not touch it. She lets the machine run through every storm. Investor B is smart, engaged, informed. When the market plunges and it feels terrifying, he sells to stop the bleeding. When it's roaring and everyone's euphoric, he buys back in to get on board. He sells low and buys high, not because he's foolish, but because he's human, and it feels right in the moment. 20 years later, they compare piles. Investor A, who did nothing, ends up dramatically ahead. Investor B, who worked hard and stayed busy and reacted to everything, ends up far behind, sometimes barely ahead of where he started. Same fund, same years. The entire difference was behavior, not brilliance, not information, not effort, behavior. And notice the cruel irony. Investor B lost precisely because he tried harder. His effort was the problem. Every time he did something, he was really just moving money out at the scary bottom and back in at the comfortable top, quietly paying a tax on his own emotions. The one who sat still won, and the one who kept grabbing the controls lost. Hold that in your head because it's the thesis of everything that follows. Beat 3. If sitting still wins, why is it so hard? Because 4 wreckers are constantly trying to get you out of your seat. Let's name them so you can spot them. Wrecker 1 is fear, the urge to sell in a crash. When the pile is dropping and red is everywhere, your gut screams, "Make it stop," and selling feels like safety. It isn't. It's just locking in the loss and missing the recovery. Wrecker 2 is FOMO, chasing whatever already went up. Something soared, everyone's talking about it, and you jump in near the top right before it cools. You're always a step late, buying the excitement and then holding the disappointment. FOMO is fear wearing a party hat, the fear of being left out. And it gets people to abandon a perfectly good plan to chase whatever just ran. Wrecker 3 is tinkering, the constant fiddling, the overtrading, the "let me just optimize this one thing" that becomes 20 small mistakes. A machine you keep opening up and adjusting runs worse than one you leave sealed. And Wrecker 4 is the news, reacting to headlines designed to grab you, not inform you. The news sells fear and urgency because that's what keeps you watching, and every alarming story tempts you to do something. Here's how you diffuse all 4 with one move. Recognize that each of them is asking you to act, and that with a well-built machine, action is almost always the mistake. The wreckers want your hands on the lever. Sitting on your hands is the skill. Beat 4, and it's the line that should be tattooed on every investor's wall. Time in the market beats timing the market. Timing means trying to jump out before the drops and back in before the rises. And it sounds smart, so let me show you why it quietly wrecks people. Over long stretches, a huge share of the market's total gain comes from a small handful of very best days. And here's the cruel twist. Those best days cluster right next to the scary worst days. They happen in the same panicked, volatile stretches, often within days of each other. So the person who gets out until things calm down is almost guaranteed to be sitting on the sidelines when the biggest bounce hits. This is a well-documented pattern, not a promise about any given year. Miss just a small number of the best days across the decades, and your ending pile can be dramatically smaller than if you'd simply stayed put the whole time. The person who stayed fully invested, through the ugliness, through the fear, captured those best days precisely because they never left. Think about what that asks of you. To earn the good days, you have to be willing to sit through the bad ones without flinching. There's no version where you get the bounce but skip the terror. They're the same stretch of road. That's the boring, proven, almost anticlimactic truth. You don't beat the market by outsmarting it on the exits. You win by refusing to leave. Staying put isn't the safe but mediocre option. Over a lifetime, it's the winning one. Beat 5. So how do you actually stay in your seat when your gut is screaming? You don't rely on willpower in the moment. Willpower loses to panic every time. Instead, you make the decision once in advance while you're calm and you write it down. This is the one-page plan, and its entire job is to let calm you overrule panic you. Here's what goes on it. 1. Your target mix. How much growth fuel, how much ballast, chosen for your timeline, written as a number. 2. Automate it. A set amount into the machine every single payday, so investing happens without you having to feel brave each time. 3. Rebalance on a schedule. Maybe once a year, on a date you pick now, you nudge the mix back to target, which quietly sells high and buys low for you. 4. Don't check it daily. The more you watch a volatile thing, the more you'll want to touch it, so look rarely and on purpose. And 5, the big one, written in bold. Never sell in a panic. When a crash comes, and it will, the plan already told you what to do, which is nothing. The magic here is that you're not trusting frightened, midnight headline you to make a good call. You made the good call already on a calm afternoon and left yourself a note. The plan is the seatbelt you buckle before the crash, not during it. Beat 6, and this is the one I actually care about most. Through this whole series, it's been easy to feel like the goal was a bigger number, a taller pile, a higher score. It was never that. The number was always just a means. The real scoreboard isn't dollars, it's freedom and time. The whole reason you build the machine, feed it, and then leave it alone is so that you don't have to think about money. So it works quietly in the background while you go live your actual life. The point of not checking it daily isn't just better returns, it's that you get those hours and that peace back. The point of the emergency fund and the boring plan is that you sleep at night. A person with a running machine and a calm mind is winning, even if their pile is smaller than the neighbor who's stressed and trading all day. Money is supposed to buy you options, not owners. And a portfolio you have to babysit owns you right back. The best-built machine in the world is worthless if running it costs you your evenings, your sleep, and your attention. That's the tie back to this whole channel. We don't talk about money because money is the point. We talk about it so it stops being the point. You build the machine once, you protect it from the operator, and then you go be a parent, a friend, a traveler, a builder of things that have nothing to do with spreadsheets. The machine runs so you can stop watching it. That's the real win. So here's how you protect the best machine you'll ever build from the only person who can wreck it. 3 moves, and they're all about your behavior, not your brilliance. First, write the plan down before you need it. Target mix, automatic deposits, a yearly rebalance date, and one bold line that says, "In a crash, I do nothing." Decide it all now while you're calm, so that when fear or FOMO shows up, the answer is already on paper and it isn't up for a vote. Calm you gets to overrule panic you, because calm you wrote the rules first. Second, starve the 4 wreckers. Check your accounts rarely, not daily. Mute the alarming financial noise that's engineered to make you act. Treat the urge to do something during a scary market as a signal to do exactly nothing. Remember the 2 investors, the one who sat still won, and the one who kept grabbing the controls lost. When in doubt, sit on your hands. That is the advanced move, not the lazy one. Third, keep the real scoreboard in view. The goal was never a bigger number, it was freedom and time. So let the machine run in the background and go live. Automate it. leave it alone, and measure your success not by how closely you watch the market, but by how little you had to. Build it once, protect it from yourself, and let it quietly buy back your life. That's the machine. The whole thing, start to finish. An engine, 3 fuels, a portfolio, switched on early, and then left alone by an operator who learned to trust it. This has been education, not financial advice, just the map, laid out honestly so you can drive it yourself. And a reminder we've made all series. Figures here are round, hypothetical illustrations. Time in the market is a well-documented pattern and not a guarantee, and past performance doesn't predict future results. If any part of this machine is still fuzzy, go back to the beginning and watch the whole series in order. Episode 1 on why, straight through to here. Build your machine, protect it from the operator in the mirror, and then, finally, go live your life, because that was the whole point from the very first dollar. Thanks for building it with me all the way to the end.